Hey everybody, Kamari Ellis here for another edition of Ask Kamari. Did something a little bit impromptu, a little bit different. Did a off-camera interview with a mortgage banker. Couldn't have him on camera because his big-time company doesn't allow for that, or else we have to go through compliance and get a whole bunch of red tape cut. But nonetheless, I was able to kind of convince him to share some of the tips, tricks, and secrets of the mortgage industry for you folks. So stay tuned. We talk about a couple of different things, whether it's PMI, whether it's first-time homeowners, talked a little bit about real estate investors, and we also talked about a lot of resources that are out there for individuals who are out there looking to buy a home. So check out this next segment, and I will talk to you soon. Bye-bye. So I've been seeing mortgage companies have lower or reduced rates, like 3% to get a mortgage. That's almost like what it was back in 2008. Is that good, bad?
Well, actually, it's really, really good. So there's some signs that the housing market has actually taken some steps in the right direction, and that, the economy is actually getting better. One of the things that we've also seen is that FHA, for instance, they've increased the mortgage insurance.
And so mortgage is like private mortgage insurance. So anytime you have less than 20% to put down, they charge you mortgage insurance, right?
Right, that's correct. So private mortgage insurance is more so for, the government agent, the Fannie Mae and Freddie Mac loans. FHA, we call it mortgage insurance because it's not private, it's the government.
Gotcha.
This money is actually being paid into a government fund that in the event that, homeowners are, to get in trouble and they lose their homes, they're going to help the banks recoup that 20%.
Right.
Because anytime you put down less than 20%, the bank feels like they're taking a risk, and they want to get a reward in the fact, so in the event that you put down less than 20%, the bank wants to make sure they can recoup as part of that investment. So they're going to require you to have that mortgage insurance.
Gotcha.
And one of the things that we've seen that we don't really like is the fact they've increased that so much that it makes it difficult for customers to afford the same house. When guidelines started to tighten up, lenders really didn't have the money to, get the money from Fannie Mae and Freddie Mac, so they went to FHA. And now FHA got flooded with a pool of borrowers.
And that's because nobody was lending after 2008,
Exactly.
Right?
Nobody was really lending. So what happened, the government said, wait a minute, we got to slow this down. We're taking on way too much risk. We want the private market to take on some risk. So sort of to kind of derail all the originations that were headed their way, they increased the mortgage insurance. They figured if we make it a little bit more expensive for people to buy, a home with FHA, then maybe they'll consider saving money. Because part of the problem that folks ran into was no one put money down. If you remember in the early 2000s, 100% financing was being sold like tasty cakes.
Nobody saves, so nobody has money to buy a home.
Exactly. So the government really wants to try and change that trend. But with all that being said, we're still in a position, like you said, where nobody's saving. So what do? We still need to stimulate the economy. We still need homes to be sold to drive that market. So, it's unfortunate that we have to, I guess, tighten up the guidelines and make sure that we don't repeat the mistakes of yesterday. But, FHA is not a totally bad product. People just need to be cognizant that not only did the mortgage insurance increase, but it's not going to go away.
So, because normally mortgage insurance or PMI, I always call it PMI, but mortgage insurance usually goes away after you pay down roughly 20% of your loan, or you get beneath the 80% loan to value. I don't want to get too technical, but loan to value ratios. So basically, if your home is worth $100,000 and your mortgage is $80,000, anything below that $80,000, you shouldn't have to pay PMI or mortgage insurance, as you call it.
In theory, you're correct.
Okay.
What people don't know is that this is not something that's automatically going to happen. It is not going to automatically happen, right?
Why not?
Because lenders are going to wait for you to notify them. They don't actively monitor your home values and everything on a monthly basis. So the only way that they know that your value may have appreciated is if you contact them. There is a way where if based on when you got your original appraisal, and if you paid it down less than the 80% based on the original value. But in this market, it's kind of difficult to gauge that because, for the first time in I don't know how many years, we've seen property values go down.
Right.
So that kind of changed the scale. So how do we know when you're at 80%?
Right. So all these underwater mortgages are probably going to be paying PMI forever.
It's quite possible that they're going to be paying PMI until they can demonstrate through an appraisal that their value has brought them down below 80%.
Now, how much is there a factoring or a way that they factor in PMI per thousand or per 100,000? So what's the cost? Well, I'm trying to figure out.
So it's kind of difficult to gauge the cost because everyone's cost is pretty much different. Your cost is going to be dependent on a number of factors, right? The mortgage insurance companies give different people rates. So let's compare this to your car insurance. If you're a really safe driver and you haven't had any accidents, your mortgage insurance is going to be less than somebody who's had 10 accidents.
So there's ratings inside of the mortgage insurance.
Exactly.
So it's not just I have a mortgage. I think the average home in America is worth 150, somewhere between 150 200,000. So I have a $150,000 mortgage. I don't know. It's $15 a month. Just arbitrarily, it's not.
Right.
It's not that cut and dry.
Right. No, it's not. It's going to depend on your credit score. So the better your credit score is,
So credit score factors into mortgage insurance.
absolutely, because that's going to demonstrate risk. When you're talking about insurance, when you're talking about financing, you're talking about banking and investing, it's all about risk. So the bank is actually taking a risk on you by loaning you money. They want to make sure they can get a return on that. So if you're a higher risk, then you're going to pay more for the insurance.
Okay. So what other factors factor into the premium of this insurance?
So then after you look at, the risk factors, you're also going to look at your loan to value, which also adds to risk. So if you're financing 95%, you're going to pay more than somebody who's financing 90%.
Okay. Okay.
And it's also the type of loan product you have.
So,
So an ARM may be more riskier than
an adjustable rate mortgage.
That's correct. So an adjustable rate mortgage could be more expensive than, let's say, a 30-year conventional fixed product. Correct. So the MI companies, they have their rates and they have their factors that they use to come up with their rates. And all of that factors into how much money you're going to be paying on a monthly basis.
So even with this 3% down that I'm seeing, folks are still kind of getting slammed a little bit because they had to pay higher mortgage insurance.
You're absolutely right. So even when you have rates as low as 3%, you got to add on the fact that you're going to be paying that mortgage insurance, which will probably bring your rate up somewhere in the 4% range. If you're to add the premium that you're getting paid plus the interest rate you're going to be paying to the bank, you're looking at a total interest rate of probably over 4%. That's what you got to kind of look at too when you're comparing loans. So you make sure you're comparing apples to apples.
So again, 150,000, 4% loan over the life. That's a big difference between 3% and 4%. So that whole percentage point goes to the insurance company for that. Maybe I need to get in the mortgage insurance business. That's pretty lucrative.
It's a good business, and I always say, mortgage insurance, those guys, they're making a ton of money because how often do you see people cashing in on those policies?
Right.
The banks rarely have to go back and cash in on one of those mortgage insurance policies.
Mm-hmm. And again, mortgage insurance pays for what?
It pays if you lose, if you can't pay for the house anymore and the house goes into foreclosure. Remember, you put down less than 20%, right?
Mm-hmm.
The banks only want you to put down 20%. If there was no mortgage insurance, everyone would be forced to put down 20%.
Right.
So that insurance covers that first 20% on that house.
Okay.
So that the bank will continue to lend money.
Okay.
So in somebody's world somewhere, they decided that 20% down is the magic number.
Yeah, they have these theories that supposedly the more invested a person is when they buy a home, supposedly the less likely they are to stop paying that mortgage. Supposedly.
Correct.
And unless we have situations like we had in 2008 when people were just leaving. But again, a lot of those folks, like you mentioned earlier, didn't put anything down.
Right.
Now, so to get the mortgage insurance removed, you said you had to get a new appraisal.
Correct.
And, that is a little fishy sometimes, especially with the values and how the market may be going at any time.
Right. So, like we said before, the mortgage insurance is not going to just fall off.
Right.
So even if you pay your loan down to where you think it should be less than 80% of what you first borrowed, you're going to have to go out and you're going to have to get an appraisal done, and you're going to have to pay for that appraisal too. And as long as the appraisal comes back fine, then you could submit the request to your lender to have that insurance removed.
And let me guess, it needs to be a company approved appraisal on their list.
Yes.
Yeah. So you can't just go to any appraiser.
No.
Okay. Well, no, I brought that up again because I think that's really important, and I wanted folks to really remember that. Now, you said a person could theoretically get a home for $100.
Yeah, I mean, and it's kind of shocking, I kind of show people that it's easier if you have your credit situation intact to buy a house than it is to buy a car, because the house isn't going anywhere, right? They don't have to chase you. If you don't pay, they know where to find that house. The address is never going to change. But there are grants out there. There are different programs out there that will provide down payment assistance. And with it still being a buyer's market out there today, sellers are more apt to want to pay the closing costs of any buyer just to want to get the deal done.
So
essentially,
find a motivated seller in order for this to work out.
Correct.
Okay.
A motivated seller.
And when I say motivated, I mean somebody who really wants to sell their house pretty quickly.
Right, but a lot of times when I have homeowners or potential home buyers that come to me and they want to buy a house, they kind of get confused when we talk about the difference between down payment and closing costs. Mm-hmm. So there are two sets of funds that you typically need to buy a house. You need a down payment, which is just the money that you're going to put down on the house. And then the second set of funds is to close the transaction. So there are going to be recording and filing fees to record the mortgage with the state, county, municipality that you live in, right? There's also going to be, title company fees where they're going to insure the title and make sure there are no liens and judgments. And then you have your bank fees and escrows. Escrows, that's your money that gets put into an account on your behalf so that when your taxes are due and your homeowner's insurance are due, the bank can send out a check directly. So they're going to collect those things at closing. So all of those things people need to consider, when they go to buy a house. So if you have $10,000 to put into a transaction, then you might not want to put it all down on a down payment because you're going to need additional funds for the closing costs, unless you find that motivated seller that will be willing to pay your closing costs for you, which is what we see a lot of times. So with a loan sort of like FHA, you're allowed to have up to 6% paid by the seller. So for most people, 6% of the sales price is enough to cover the closing costs. So the seller can contribute that. Okay. And if you get a grant from a nonprofit organization or from the state or even a gift from a family member, you can get that and put it down towards your down payment, which is only a 3.5% requirement.
Now, there are a lot of grants out there. There are a lot of organizations.
There are a lot of organizations out there. It's just that, people have to really, use Google. Google should be your best friend. They're out there. Look for the nonprofit organizations. There are a lot of counties that even do a dollar for dollar match that most people don't know. It requires you to sometimes go to a few home buyer courses or classes, and then they'll do a dollar for dollar match.
So you're talking about like the first time home buyer courses?
Correct. So if you put down $5,000, if you show that you saved the $5,000, they'll put down an additional $5,000, so you'll have enough money for your down payment. Some of those programs have some caveats. If you move into the town, you can't move for 5 years or anything like that.
All the money back or something.
Right, or you have to pay it back. But if that works for you, then you definitely want to take advantage of it.
What about for investors? I have a lot of real estate investor clients. Are there programs out there for them that they could take advantage of?
There really aren't a lot of programs like that for investors. Investors, they're investing. They're higher risk. When you're talking about financing, the first house to go is the investment property. It's never going to be somebody's, primary home if they get in financial trouble. So that's a higher risk for the banks. So the banks are going to require people to put down a significant amount of money.
Okay. That's usually 20% or more.
Correct. Yeah, so 20% or more.
How do the mortgage companies look? Because I know a lot of investors get creative. So they'll have the seller finance closing costs. They may also have the seller hold back the paper or hold back part of the mortgage. Does the mortgage company look at that favorably or unfavorably?
Well, they actually restrict a lot of the, if the seller is going to pay closing costs, then they're limited to 2% on an investment property versus the 6% that a primary homeowner would be entitled to. So they do restrict a lot of those guidelines.
Okay. And what about withholding the paper back or part of the
Yeah, then they're going to look at
Qualify.
that combined loan to value. So
Okay.
when we say that we're going to go 80%, that's going to be combined loan to value.
Okay.
So they're still going to need 20%. Whether we lend them 60 and the seller lends them 20%, the max that we're going to go is 80%. They're going to have to come up with 20%. That's going to make sure that the bank is protected.
Okay. So again, I'm talking about holding the paper back, what some people call. So if you're buying a property, an investor is buying a property for $100,000. The bank will lend 60% of that. The seller can finance a part of the new buyer's purchase for that other 20% of that other 20,000, and then usually the investor may have to come up with 20,000.
Correct.
But sometimes you see them where they're able to kind of negotiate and get the seller to finance all of it. Sometimes, right? You
Correct.
see that? Okay. All right. Any other tips, tricks, secrets that the people should know about what's going on?
I think the most important thing is to just, your credit is the most important thing. Just making sure that you have timely payments. If all you have is the minimum payment, just make that. Because when we look at credit, we want to see what your ability to repay is. So as long as you have been constantly, if you can't pay them the full amount every month, that's fine. Just pay them something. Pay them the $15 a month.
Now, is there a credit threshold that you need to get that 3% that we're talking about? Is it 600?
A variety of lenders have different criteria and they place different overlays. I will say the standard with FHA is that there's no score, right? Now, the
So
problem
if you got a 500 score, you can get a loan.
that's what the standard is. Now, here's the difference. Banks have overlays.
Right.
So even though FHA says that we don't have a score requirement, XYZ bank may say our minimum score is 620.
Okay.
So in terms of FHA, the magic number is typically 620 to get 3.5% down. My job as the mortgage professional is to paint the best possible picture of you. I'm on your side, right? So you got to give me the ammunition so I can paint the best possible picture of you so that I can show that you're not a risk and that you're worthy of this loan. So for you, the idea is for you to paint the best possible picture of yourself with how you pay your bills on time, with how long you stay at the same job. It's okay to progress and move from different job to job if you're increasing income.
Okay.
But if you're getting let go from job to job and there's long periods of unemployment in between, we're going to look at that and we're going to ask you to give us a letter and explain what happened there.
Okay.
So we can kind of put the pieces of the puzzle together.
Okay. All right. Well, I think you've given a lot of information. I appreciate your time with it.
Thank you.
Thank you.